For 2.6, we're going to record a worksheet like we did in the previous exercise. However, at the end, we're actually going to make a balance sheet from the information we produce. So first of all, the owner contributes $58,000 to commence the business. We know cash goes up, so does owner's equity. April the 2nd, bought goods to sell in the shop for $12,000 cash plus GST. So this is just saying we bought goods to sell, they haven't actually been sold. So the business has more inventory. It's been charged GST, which reduces our liability, and then we need to factor in how was this paid for. It was paid with cash, so cash will decrease $13,200. On the 3rd, we have our first sale. It's a cash sale for $3,000 plus GST and a cost price of $1,500. So we deal with the sale amount first. I've received $3,300 cash. That represents two things. GST I've received that doesn't belong to the business, so it increases the liability, and the $3,000 is revenue, which will increase owner's equity. But we can't make a sale without a cost of sale, so we need to factor in the fact that I had to give up $1,500 of stock to make this sale, so stock is decreased. The other effect of that is it becomes what's called a cost of sale expense, and expenses will decrease owner's equity. April the 4th, paid rent $500 plus GST. Business has $550 less cash, so cash will decrease. Been charged GST, so GST will go down, and rent is an expense, so that'll decrease owner's equity. April the 5th, bought stock on credit $8,000 plus GST. We have more inventory. We've been charged GST, and the other effect here will be that cash has decreased. Well, it won't be actually, because in this case, unlike the previous transaction, it hasn't been paid for in cash. What's happened here is that we bought on credit, so creditors will go up for the full amount. We're going to owe a creditor the $8,000 for the stock plus GST of $800. So you can see it's the same transaction as April the 2nd, stock up in both situations, GST down in both situations. What's different is that unlike cash at bank going down on the 2nd, in this case creditors goes up. April the 6th, we made another sale for cash, so we should be able to deal with that quite easily now. $5,500 cash received, made up of GST and revenue, and then the cost of sale is $2,000, which decreases stock, and it's an expense which decreases owner's equity. On the 7th, we paid creditors $2,000 owing, so you can see here we owe a creditor $8,800, so we're going to decrease that amount by $2,000, and we've lost cash to do it, and creditors will go down by the same amount. On the 8th, we borrowed $5,000 from Easy Finance as a loan. So the business has more money, so cash goes up. Where does it come from? We've now got a liability called loan. And lastly, sold goods for cash, $14,000 plus GST, with a cost of sale of $6,500. So straightforward transaction now. Cash goes up, GST goes up, and so does revenue. And we have to sacrifice inventory to make it, which is a cost of sale. Total up our columns in the bottom row, so that total assets, liabilities and owner's equity, and then total each section up, we get $81,450, $11,950 and $69,50. Let's just check that actually works and does balance. Assets of $81,450 must equal liabilities of $11,950 plus owner's equity of $69,500, and it does balance. But more importantly is not the worksheet, which won't be on the SAC, it'll be the balance sheet. Can we now turn these totals into a balance sheet? So the first thing we'll start with is our current assets. Now we've only got two assets, so we've got cash at bank and stock. So being the only assets, we can total that up and know that that's all of our assets. So we'll move on to current liabilities. The GST is a positive figure, so what that means is it's a positive liability. We owe the government money, so that's a current liability. We also have creditors, which is a current liability, and then we've got the loan, and the question doesn't say whether it is current or non-current. On any SAC or exam, it would be quite clear as to what it is, so it really doesn't matter how you treat it for this question. I'm going to assume it's actually non-current. There's no information indicating that, we'll just make that assumption. Lastly leaves owner's equity or capital of $69,500, and we've dealt with all the information. All we've got to do now is total it up. So we'll go to current assets and total them up. Now total assets is easy because there's no non-current assets. Current liabilities will be there, and the loan for non-current, remember we need to transfer the total to the second column. Same with owner's equity or capital, and then we'll total up total equities, and that proves that our accounting equation does balance.